Nice to have you with us on this Tuesday morning. Let's start with the Canadian economy. You were probably hearing Paul Bagnall about a half hour ago talk about the latest inflation figures for Canada. Now, there's two parts to this story. The headline story tells us that inflation slowed the most since September. A big consideration there was the elimination of the consumer carbon tax and lower oil prices. But keep in mind, because we were anticipating some of that, a lot of the players on Bay Street were already expecting an easing in inflation. So looked at another way, you could argue this print was hotter than some had thought. And then there's underlying factors we have to continue to watch, like what you're paying at the grocery store. Now, as we watched the market reaction this morning, we saw the Canadian dollar showing some signs of strength, which would indicate that for those who are wondering if the Bank of Canada is going to get back to easing rates, especially after a recently dreary jobs report, maybe we have to think twice about that. We also saw in the fixed income world, two-year yields, for example, moving higher. Let's just talk a little bit more about the market reaction and the state of Canada's economy. Earl Davis joining us here to kick off the hour. He's head of fixed income and money markets with BMO Global Asset Management. Nice to see you.
Good morning.
So again, you've got kind of this headline that almost suggests the inflation picture is improving. Does it end up being a little bit misleading, do you think?
Well, it depends on your perspective. If you're a consumer, no, it's not misleading. You know, we're up 1.7% year on year. Gas prices are lower. We're all good. That impacts expectations. If you're a central banker, it's not confusing, but they're not looking at headline. What they're trying to do is, you know, gas is very volatile in CPI. It moves up and down very rapidly, as we've just seen. So they remove that. So they look at CPI without energy, without food. That number was 3.2%, I believe, which is higher than their range of 1 to 3%. So from a Bank of Canada perspective, it does complicate the easing. It does delay it. I was thinking there was a possibility of an ease at the next meeting. I am now not thinking there will be an ease at the next meeting by the Bank of Canada because of CPI.
And they had already hit the pause button, correct, at the last meeting, just because they wanted to see how things would play out with the trade uncertainty?
Correct. So they did hit the pause button. The reason why I thought they could possibly resume was the unemployment number. We're seeing unemployment start to rise. And also the housing numbers. We're seeing housing start to go down. The housing sector is one of the biggest employment areas in Canada. So usually when you see unemployment start to rise, it starts a trend of rising. So from a Bank of Canada's perspective, if less people are working, less people are spending money, there's less demand. So then they could anticipate lower inflation in the future and ease. So I was thinking that until I saw today's number. I think it's going to be a surprise for the Bank of Canada as well, too.
Okay, so a little bit of dancing in the short term, but you're talking about long term,
yes.
a lingering uncertainty for Canada's economy. Does it still make sense, do you think, for the Bank of Canada to be tilting towards cutting rates a little further rather than, you know, just sort of staying on hold for the foreseeable future? So
the answer is yes, with one thing of note, that's fiscal, and I'm going to come back to that in a second. Okay. So yes, it makes sense for the Bank of Canada to ease rates by the end of the year to get us into what they call easy monetary territory.
Yeah.
The reason why they want to do that is several reasons. One, I do believe they would like to get housing back on stable footing. That's good for everyone. And getting that back gets employment back on stable footing. So I think they want to offset those two things. There's one big caveat, which I mentioned before, that's fiscal spending. If the Bank of Canada sees that the new government will start spending to stimulate the economy and get things going, they may hold back on easing as well, too. So there is one caveat there, but yes, I do think they would like to ease by the end of the year.
All right. And, obviously, this new federal government and Prime Minister Mark Carney came in with this pledge to be spending in this time of uncertainty. But since we constantly hear about the uncertainty, how would you characterize the overall state of Canada's economy? I know you talked about signs of weakening in the jobs market, the worries for the housing market. But for anybody who's like throwing around words like recession or the possibility of recession, like what is the state of affairs overall right now?
I think there's two time frames. So in the short to medium time frame, I think the state of affairs is not too bad. The reason why I think it's not too bad is U.S. is still doing well. They're still, producing. They're still spending, and that always impacts Canada. But we're seeing a resilience in Canada. Canada coming together. We have to see what the impacts are in intra-provincial trade barriers. That's going to be a big thing in regards to the Canadian economy. But overall, I think it's doing all right. They're not too bad. Where the concern comes in is longer term. When you see the companies like Honda pull back on the battery plants, when you're not seeing the multi-billion-dollar investment come into Canada, that's the thing that has to change from a long term to get our productivity up and to get the GDP higher.
And I was mentioning that speaking of higher, the Canadian dollar is a little bit stronger this morning. Traders just trying to sort of figure out where we are right now. I guess, if there had been a stronger sense based on this inflation reading that there'd be an ability for the Bank of Canada to ease rates in the short term, maybe you would have seen a different direction for the loonie. Do you have sort of a ballpark on where you think the currency is going to trade over the short term here?
Yeah, for the first half of the year, I was generally negative. I had a negative outlook on the currency because of tariffs, because of the uncertainties. One interesting thing that has changed that, and you actually showed it in a chart earlier, the TSX. We're at highs for the year.
Yeah.
That is a reflection of our commodity-based, the commodity base, as well as some of the technology in Canada. That's very positive. That's what gives me a good short and medium-term outlook. Because of that, that is supportive of the Canadian dollar. It means you get stronger Canadian dollar. Why? You get more international people buying Canadian dollar stocks. They need Canadian dollars to buy that. So part of that new high in the TSX is related to the stronger dollar, and I think we hold on to that. So that's constructive for the dollar.
All right, and you're the fixed income guy, so let's just come back to what people in that world are thinking. If it's not quite clear what the road ahead will be for the Bank of Canada with rates, how do you approach investing in fixed income, do you think, right now?
So we do anticipate what we would call a range. We think it's not going to go lower, significantly lower fixed income. It's not going to go significantly higher. That's a very good time to invest in corporate bonds and coupons in regards to being able to always get that coupon. Why we like that is if you buy a Canadian government bond, let's say you buy a 10-year bond or 30-year, it's around, let's call it 3.25, that's your interest rate. That's still above overall inflation of 1.7. That means if you invest in a bond, you will have more money to spend next year than you have this year. So we think it's a constructive environment for adding to corporate bonds, for having a balanced portfolio, corporate bonds and bonds in general, as well as equities. We think it's constructive for that. You're earning a decent coupon, but it will be a little bit volatile.
All right. Well, hold that thought, because some people are debating whether it was constructive for Moody's to downgrade the U.S. debt. A big story that a lot of people were chewing on over the weekend. Earl Davis will stay with us. When we come back, we'll talk about that big credit change courtesy of Moody's stripping the U.S. of its top credit rating. We'll be right back.